for those students who may be late. So if you're just joining us on Facebook or YouTube Live, welcome. We're going to talk about investing today. This will be week 11 at the University of Houston in our personal finance class. You'll notice there's a big bright sunburst behind me. The sun is hitting the windowsill. That will go away in a minute or two or three. So sorry about that. I'm not going to close the shade because it's a sunshiny day here in Houston, Texas, and it's absolutely beautiful. So let's jump over. I'm going to jump over into Zoom, and I'm going to let some folks in. Need to get rid of some of my stuff on my screen. Okay, here we go. Welcome. Hey, Harsh, how you doing? Can you hear me? Testing audio. Hey, Elizabeth. Let's see. I'm looking in the chat. Somebody tell me you can hear me. That would be great. If you can't hear me, you're saying, yes, you can hear me. Good. Thank you very much. So, Elizabeth, you like my new microphone? This is a Heil. This is new. It's actually old, but I resurfaced it. So, hopefully the sound is good. Good. Yeah, it looks nice. I like it. It's kind of, where's the Heil? There's the Heil and there's the Heil. This used to be like the coolest microphone you could own if you were a podcaster. Thank you. Cliff Ravenscraft, my friend at Podcast Answer Man, turned me on to this amazing audio system that became way too sophisticated for me to use. And then I discovered this little digital mixer. So if you're into audio stuff, I'll tell you about that sometime. But for about $100, I got this little desktop digital mixer that allowed me to pull my Heil microphone out of the drawer and put it back to use. I'm excited about that. Okay, we're going to talk about investing today. It's 10:01 a.m., so we got plenty of time to just chat. Hope you guys had a safe and happy Halloween. I did. I wore this mask and scared lots of people. So that was fun. It's always fun. Actually, I live on a street, Sunset in Friendswood, Texas, where we've lived there for 21 years. And we have never had, believe it or not, we have never had a single trick-or-treater at our house. We have no sidewalks. It's a very busy street, and there's lots of neighborhoods that are much more productive if you're trick-or-treating. And I say productive because when I was a trick-or-treater, my goal was to get a lot of candy. So if you come to my street, the houses are spread out, and it's a very busy street, and there's no sidewalk, and it's just not productive. So yeah, we don't have any trick-or-treaters. So I wore my mask, waiting again to scare someone, and I didn't get a chance to do that. Hi, Tanya. Good to see you. Hope you had a good week. Your mask is much nicer than mine. So I'm sorry about the big light behind my head. That'll go away in a few minutes, but it's a beautiful sunshiny day in Houston, so I figured I'll let the sunshine in. This is my office at the Technology Bridge, and I'm sitting here in this amazing room, the Innovation Center. It's pretty cool, and this is where I do my work, so that's what it looks like behind me. Anyway, let's see. It is now 10:02 a.m. So does anybody have any questions? If you have any questions, want me to answer any questions, feel free to post those in the chat. We're going to talk about investing again today. Last week we talked about the 4 investment strategies that are designed to help you maximize returns and minimize risk. And I asked you last week just to outline the video, the Zoom call that we did, because I wanted to make sure that you got as much out of that video as possible, that Zoom meeting. Very important. I think it's really the most popular topic. Investing is the most popular topic in this course in personal finance at the University of Houston. And I'm pretty sure that's true. And if that's true, then the 4 investment strategies that are designed to help you maximize return and minimize risk are that's the most popular lesson. So hopefully you learned a lot from that. But again, my goal, my hope is that you learned the 4 strategies so that you're aware of them, and you can then begin to build on your knowledge throughout your investing life. But the 4 investment strategies, I'm just going to name them off. I should ask you to do that. In fact, let me just do that. Go ahead, if you're listening on Facebook Live or YouTube Live, or even if you're listening later, just pause the video if you're not watching live. And if you're watching live, do it right now. Just name the 4 investment strategies we talked about last week. And I'll give it a minute, and then I'll read them off. Mercy, that's right. That's one of them. I'm not going to mention it just yet. But hey, Mercy, to answer your question, I will be grading everything that's in the queue. I haven't graded for a few days. I've been working on a personal project, helping my daughter rebuild her house in Seabrook. So I've been really busy with that. I will get to all of the grades that are in the queue in Blackboard today. So I see 1, 2, Tanya, that's correct. Mercy, that's correct for number 2. Jacob, yes, that's correct. I see 1, 2 from Elizabeth. You named 2 of them. Tanya, that's correct. Okay, so I see, let me see. And I'm just going to name them off now because nobody, at least in the Zoom chat, nobody named all 4 of the investment strategies. So collectively, you did. As a team, as a cohort, you mentioned all of them. But let me go ahead and mention the 4 investment strategies. It's 10:05, so we'll get started as soon as I review. Thank you, Jessica. Jessica named them, and she named them in order. Way to go, Jessica. So diversification is number 1. It's the simplest and probably most fundamental investment strategy that's designed to help you really manage risk. But it also helps you manage returns. So the second one, which is the most important determinant of your portfolio's results, is asset allocation. So it's a really key, really important strategy. Asset allocation, which is the second investment strategy designed to help you maximize return and minimize risk. Asset allocation, the single most important determinant of your portfolio's returns. And so to understand asset allocation, you have to understand what is an asset class. And so we spent some time talking about small cap, large cap, bonds, international. So you need to really start to think about, as you become an investor, as you start to put money into your 401k, when you sign up for your 401k, for example, you'll be required to say, okay, yes, I want to invest this much per paycheck or this much per year. And you always want to do at least the amount that will give you the full match. Again, that's the perfect investment. It's a 401k. It's a type of account, and that's a critical piece of your whole investment strategy, is to take advantage of that perfect investment. But when you do that, the day that you sign up for that dream job that you just got, you're going to say, yes, I want to participate in the 401k, but you're going to have to say, how much do you want to contribute? And again, you always want to contribute at least enough to get the full match. So the next thing you're going to have to do is you're going to have to say, how do I want to invest this money in this account? And that's where asset allocation comes into play. So you're going to have to say, okay, large cap, small cap, mid cap, bonds, international. So that's asset allocation. It's not really that difficult, but you need to understand what it is, because when you think about this big, important asset allocation strategy, the one that's the most important determinant of your portfolio's returns, asset allocation, you got to understand what is an asset class, because that's really how asset allocation works. So that's number 2. Number 3, what I believe is the most powerful investment strategy of all for students, for anyone in your age group. So the longer you have to invest, the more powerful dollar cost averaging is for you. And we use the illustration, the story of Farmer Joe, who decided he was going to invest in cows, and cows started out at $100 a head, and he was investing $100 a month. So dollar cost averaging fundamentally is a systematic approach to investing where you set up an amount that you're going to invest, and you invest in whatever asset classes you're going to invest in. In Joe's case, we used cows just to illustrate how simple it is to see how powerful dollar cost averaging is. So he started out investing $100 a month. Cows were $100 a head. He got one cow. The next month they dropped to $50 a head. He got two cows, and we did that for 7 months. And over those 7 months, Joe bought 19 cows. At the end of the 7 months, he had invested $700. But over those 7 months, because the price of those assets, cows, went up and down, he started at $100 a head. He ended at $100 a head per cow. But over the duration of his investing 7 months, he was able to buy 19 cows. So at the end of 7 months, they're worth $100 a head. That's $1,900. He had invested $700, and his profit was $1,200 if he sold all the cows at $100 a head at the end of the 7 months. And that illustrates dollar cost averaging. And the reason that I say it's the most powerful strategy designed to help you maximize return and minimize risk is because the market, as I showed you in those charts last week, the market, if you invest in, say, a large cap stock, my favorite investment of all time is, for 1,000 extra points, does anybody remember what my favorite investment of all time is? Yes, Jacob, you got it. SPY, which is an ETF, an exchange traded fund. It's a type of investment. And the SPY is like a proxy, a replacement. You buy one investment, the SPY, and you get the entire S&P 500 in that one investment. It's an amazing investment, in my opinion. Very low expenses. It has relatively good dividends, but it gives you exposure to the entire market. And so if you look at that chart for the SPY, which is a great proxy for the market, if you look at the SPY, it goes up and down. It goes up and down pretty significantly. If you look at a chart, I should show you a chart, but I don't have my iPad hooked up. At any rate, dollar cost averaging allows you as an investor to take advantage of those ups and downs in the market. And that's why dollar cost averaging is the most powerful investment strategy designed to help you maximize return and minimize risk. You set up your systematic investments and you let the market do what the market's going to do, and you just keep doing what you've committed to do in terms of your systematic investing plan. Dollar cost averaging allows you to take advantage of that without having to be stressed about the market going up and down. And when the market goes down, you get to feel good that you're investing a systematic amount, and over time the market's going to go up and you're getting a huge discount, just like Farmer Joe got a discount when he was buying cows at $20 a head. So hopefully that illustration, that story, that example helps you understand dollar cost averaging and why I say it's the most powerful investment strategy for you if you want to maximize return and minimize risk. So that's number 3. Number 4, it's pretty simple. It's portfolio rebalancing. And so you think about asset allocation. I always like to think about just a circle, make it a pie. So it's got 4 sections. You got 4 different asset classes in that circle, in that pie. Over time, one of those asset classes is going to go up, and one of the others is going to go down. And so portfolio rebalancing just gives you the opportunity to do something like dollar cost averaging, where you take your profits from the asset class that went up, you sell that off so that you can buy the asset class that has come down. So think again like dollar cost averaging and Farmer Joe buying cows. Portfolio rebalancing is just another systematic way for you to manage your investments so that you maximize returns and minimize risk. So it's a great tool every 6 months, every year, every quarter. You don't want to rebalance your portfolio too often. It doesn't help. It doesn't work. But you do want to do it systematically over time. And in your 401k, you can do that too. You just jump into your account online, you look at the asset allocation, you hit a button, and it says rebalance. And many 401k plans now have systematic automatic rebalancing. So it's a strategy. It's important for you to understand. And portfolio rebalancing is the fourth investment strategy designed to help you maximize returns and minimize risk. So again, diversification, asset allocation, dollar cost averaging, portfolio rebalancing. Understand those. You've already taken the quiz if you turned in your assignment, but they're really important. They will make a huge difference in your investing life. I promise you. Okay. Today, we're going to talk about types of accounts. So you see I've got my buckets all laid out, and these buckets are my props for today. So we spent the last couple of weeks talking about investments. We talked about the perfect investment. And the perfect investment, somebody go ahead and leave a comment and tell me, what is the perfect investment? I mean, as a fiduciary, as a guy who's got a securities license, it's a little bit risky for me to talk about the perfect investment because it sounds like I'm selling you something, like you should invest in this. And I am selling you something, and you should invest in this, but it's not really technically an investment at all. But it's the perfect investment. Yes, Mercy and Tanya, it's your 401k, and it's the idea that if you choose to contribute to your company 401k, and if it has a match, and if you contribute the minimum amount necessary to receive that full match. So the example I always use is you make $100,000 a year. Let's say you have a 6% match from the company. If you go ahead and contribute $6,000 a year to your 401k plan, you're going to receive a match, a 6% match. And in that scenario, that very simple scenario, $100,000, 6% means you invest $6,000. That's $500 a paycheck if you get paid every 2 weeks. And you invest that at the end of the year. You've now got in your account not just $6,000, which is what you contributed, but you get the company match as well. So now you've saved 12% of your income towards retirement. And as you look at those 7 baby steps that at some point, hopefully you got to look at the Dave Ramsey 7 baby steps. They're pretty simple, but pretty helpful. One of those baby steps is to invest 15% of your income towards retirement. So that seems like a hard thing to do for most people, but not for you, not if you're taking advantage of the perfect investment, because you're getting a company match, which now brings you from 6% of your income towards retirement, but you're getting 6% match. So now all of a sudden you are saving 12% of your income for retirement. Okay, that's just one way to look at it. But in addition to the match, what you get is a tax deduction. So that helps you save money, because now instead of paying taxes on $100,000, you're paying taxes, in this example, you're paying taxes on $94,000 instead of $100,000. So that tax deduction is just another enhancement. That's why I call it the perfect investment. The second law of personal finance. In this course, there are 3 laws of personal finance. Go ahead, if you know what they are, for 1,000 extra points. These are imaginary points, obviously. I'm not giving anybody 1,000 points. But if you know what the 3 laws of personal finance are, you will impress me significantly if you'll just go ahead and write them. The first law of personal finance is the law of spending and saving. Spend less than you earn so you can save more for what matters most. That's the first law of personal finance. It's the most important law of personal finance. It's also the most disregarded law of personal finance in America. And if you don't believe me, just look at the federal government. Spend less than you earn so you can save more for what matters most. It's a key, and you got to learn how to do it. And that's why we spend so much time in this course focusing on debt management and credit cards and budgets. So that's the first law of personal finance. But one of my favorites, the second law of personal finance, is the law of tax-advantaged investing. And that's what we're going to talk about for the rest of today's lecture, the rest of today's Zoom meeting, is tax-advantaged investing. When we talk about types of accounts, and I'm going to use buckets to illustrate different types of accounts, we're talking about tax-advantaged investing. And when we talk about the perfect investment, the 401k, that is a perfect example of a type of account. Okay, so when you put money into your 401k, that's not technically an investment. You have to select what are you going to invest in. My favorite investment is the SPY. Most 401ks would not let you invest in a single ETF or exchange-traded fund. Most 401ks are going to have either index funds or mutual funds, which are very different than an exchange-traded fund. But that's beyond the scope of today's lesson. It's just to help you understand the distinction between a type of account. In other words, the bucket that you're putting your money in, like a 401k is a type of account. It's just a bucket. And I'm going to explain how that bucket works in your whole investing program today. But that's a type of account. And when we talk about tax-advantaged investing, we're talking about types of accounts. We're not talking about asset allocation or investments, really. We're talking about types of accounts, because tax-advantaged investing is all about types of accounts, okay? So where were we? Types of accounts, 401k, perfect investment. Now we're going to talk about types of accounts. But before we do, I want to just mention this little, if you wonder what this is a shovel. And I probably have told this story already, and maybe you heard it, maybe you were on Facebook or Netflix or just doing something else, but I just always like to tell this story. I feel like I'm a very blessed person. I have earned more money in my life than I think I'll ever be able to spend. And my wife, who is way more frugal than I am, she's not going to spend it either. So I'm very thankful. The objective of this course is I want to teach you how to become a millionaire by the time you're 50. And usually one of the first questions anyone should ask when someone's trying to teach you something is, before I trust you to teach me that, I want to know if you did it, if you actually know how to do what you're teaching me to do. And the answer is yes. By the time I was 50, I had a net worth of $1 million, which from my life schema, it was a big goal for me. And I was grateful that it was achieved. And so the way I did that, the reason this is important, is because when I was very young, like, 10 years old, I wanted a pair of tennis shoes. I wanted a pair of leather Converse tennis shoes. So if you probably don't remember Dr. J, Julius Erving, he was Dr. Dunk. He was like this superhero when I was a kid, before Magic Johnson came along, who I went to high school with. But anyway, I wanted these tennis shoes because they were cool. They were leather Converse tennis shoes, and they cost $10. Crazy, I know. At the time, you could get them at Kmart for $10, but you could buy Converse canvas Converse. So, the fabric Converse tennis shoes. Back then, you could buy them for $4 at Kmart, and that's what my mom would buy for us. We had 4 kids in the family at the time, and so that my dad worked, my mom didn't work. We didn't know we were poor, but we didn't have iPhones. Nobody had iPhones. But anyway, I wanted these leather tennis shoes, and I went to my mom, and my mom said, "No, it's not in the budget. We can't afford it. Talk to your dad." I kept pestering my mom. She finally said, "Talk to your dad," which means the answer is no, but if you can talk the big guy into it, then more power to you. which was way better than just plain no. So I went to my dad and I said, Dad, all my friends have these leather tennis shoes. I really like them. I think they'll last longer. They're, but they're $10. Will you please get me a pair? And my dad said, no, I'm not going to get you a pair, but here's what I'll do. The Converse canvas tennis shoes cost $4. That means you're $6 short. If you come up with $6, I'll give you the $4, and you can use the $4 with your $6, and you can have whatever you want. He said, by the way, Jim, I was little. It was a Saturday, and he said, look out there. It had snowed. I lived in Lansing, Michigan. It had snowed. We had a lot of snow. And he handed me a snow shovel. He said, if you go knock on doors and ask people if you can shovel their snow for them, they'll pay you to do that. I was a big kid. I was strong. I thought, that's a great idea. I never thought of that I never would have thought of that on my own. My dad said, that's how, if you want to make some money, do that. And so I did that. I actually went out and started knocking on doors, and they were neighbors, but most of them didn't take me very long to get past the few neighbors that I knew into the neighborhood where, they may have seen me walking to school, but they had no idea who I was. Knock on the door. Hello, my name is Jim. Or Jimmy. I live down the street. I just wanted to know if you wanted your snow shoveled. Would you like somebody to shovel your snow? So here's this little pudgy kid, big pudgy kid with a red face and lots of energy, and you can't imagine how many people said yes. I spent that whole Saturday shoveling snow. Eventually I got my friends to help me, and they got a piece of the action. I became an entrepreneur pretty quickly, and I never, for the rest of my life, didn't have money in my pocket. And I, attribute it to that experience where my dad said, hey, look out there. People need work done, and you're capable of doing work. And so in terms of producing income, that's what this shovel is about. That's why this is part of today's lesson, because without this shovel, without you applying yourself to do some work, and I'm talking about manual stuff that you can do. I mean, yeah, maybe you can use your mind and do something smarter that doesn't include manual labor, but for most of us, there's tons of manual labor that needs to be done, and people who are happy to pay you to do it. I'm paying some guys right now to work on my daughter's house. I'm paying them hundreds and thousands and tens of thousands. Well, it'll be over $10,000, and they're doing something that they learned how to do. I wish I knew how to do it. I know how to do a little bit of that kind of stuff, but frankly, I have other things that I'd prefer to do, because I'm old and it hurts. But if you're young, learning a trade, learning just to do something like knock on doors. It was a huge gift to me what my father made me do for those tennis shoes. And, then I got to buy those tennis shoes and a whole bunch of other junk that I didn't really need, but I had the money to buy. And I could buy anything I wanted because of learning that life lesson that earning money was really pretty easy. You just apply yourself. I had to give up some kickball games, and I had to just go out and work. But that's the reason this is part of today's lesson, and it's an important part of today's lesson. So back to the buckets. So I want to give you a quick overview of 4 different types of buckets, 4 different types of accounts. I'm going to do this pretty quickly. Your homework assignment this week is going to be to learn about different types of accounts, including an IRA, a 401k, a Roth IRA. You're just going to learn some of the basic things about those types of accounts, how they work, and what are some of the rules, boundaries, and limitations related to those different types of accounts, those different buckets. Okay, that's going to be your homework, and that's what you're going to learn this week. And you're going to take a quiz, and you're going to forget most of what you learn. But that's okay, because again, just like investing, learning about asset classes and investment strategies, you have to start by just getting introduced to the concept, to the idea, to the facts. And that's what this lesson is, and that's what this week is about, is for you to get introduced to the big idea of types of accounts, which falls under the second law of personal finance, which is the law of tax advantaged investing. And I promise you, it's a very important part of building wealth over your lifetime. So once you understand how the investment strategies work, and you couple that with types of accounts and tax advantaged investing, you will start to see results in your investment plan that by the time you get to be my age, you will see that what I'm telling you now is true. My promise is that becoming a millionaire by the time you're 50 is really not difficult if you do a few basic things. And these are the few basic things. And that's why they're part of this course. So types of accounts, 4 buckets. The first bucket is this just big blue bucket. And so if you own a house, if you own a motorcycle, if you own a car, if you own an iPad, an iPhone, a MacBook, an iMac, a Heil microphone, all of the stuff you own is in this, this is kind of an imaginary bucket. Now, technically, this bucket could be an account at the bank. It could be an account at TD Ameritrade or Charles Schwab or E-Trade. It's just an account, okay? So I named a bunch of stuff that's not even, it's not really financial assets. So this microphone isn't in an account. That was a bad example. But let's say I owned shares in Heil, the company that builds this microphone, or I own shares of Apple, the company that built my iPhone 13 Pro Max, which I took my first video with this weekend. Took my grandkids to Dewberry Farm. I'll share the video with you sometime, but amazing. This is amazing. But so if I own Apple stock, and I just bought a new MacBook Pro with the M1 Pro Max chip, I'm crazy about these machines, so I obviously want to own some Apple stock. And if I own them in this bucket, if I bought Apple stock in 2009, Apple stock was $125 a share in 2009. If I owned it in this bucket, it's very different than owning it in some of the other buckets we're going to talk about, because in this bucket, there's no tax advantage, no tax benefits. Okay, this is just, you can put as much as you want. There's no rules for how much you can put in it, but there is a tax code, and you do pay taxes on the gains in this type of account. So that's what this bucket represents, is just no tax benefits. It's any type of account. It could be a bank, could be Schwab, could be TD Ameritrade, and anything that you own in this, any investments that you own in this, it could be the SPY. When it goes up, if you sell it, you're going to pay tax on the gains. So that's important. So that's what this represents. This big bucket has no limits, but you get no benefits. There's no tax advantage to investing in this bucket. So the next bucket, which is a large metal bucket with a tag on the bottom of it. So this bucket represents your 401k. Now, it's metal. This bucket is plastic. So this bucket has some important protections. But more importantly, it has some tax advantages. We've already talked about them. So the 401k, the money you put into this bucket, you get a tax deduction. So this doesn't just represent a 401k. You could work for the government, or you could work for a nonprofit, and those have different numbers, but they're the same bucket, okay? So does anybody know, if you work for a church or a school, what you would be investing in? I mean, it's the same type of account, but instead of a 401k, it's some other number. There's other numbers, and you're going to learn about that this week. What are those numbers? So one of them is a 403b. Have you heard of that? A 403b would be for teachers or someone at a nonprofit, but it's essentially the same bucket, okay? I call it the 401k bucket, but it's the company retirement plan bucket, and it's big. It's not as big as this one, but it's big. You can put a lot of money in it. Okay, so that's that that bucket. So the next bucket we have is a bucket that everybody needs to know about, and it's smaller, and it's called an IRA, a tax-deductible IRA. Does anybody know what IRA stands for? I'm going to wait, give you a second to go ahead and chime in, because I promise you nobody's going to get this right. IRA, technically right. You'll get it right. And everybody calls it the same thing, but it's not exactly technically correct. So what does IRA stand for? If you're watching on Facebook or YouTube, go ahead, leave a comment. What do you think IRA? Go ahead and hit the send button so that your comment is recorded before I tell you the actual technically correct. Oh my goodness. I stand corrected. Jacob got it correct. Jacob, Marco, you said what I would say, what most people would say, individual retirement account. That's what most people think an IRA is. But Jacob, you're the man. You got it right. Individual retirement arrangement. So I'm shocked. You must have Googled that, or maybe you've been listening to Dave Ramsey. Dave Ramsey likes to point that out. So IRA stands for individual retirement arrangement, but we're going to just use IRA as individual retirement account. It is your account, okay? And again, you're going to learn about this bucket. You're going to learn some rules, boundaries, and limitations for this bucket. But the main thing I want you to know is that this bucket is similar to this bucket, except this bucket is a company retirement plan, and this is more of an individual retirement arrangement. So this bucket and this bucket act very similar. When you put money in this bucket, it's tax deductible. When you put money in this bucket, this IRA, it's also tax deductible. But there are lots of rules around that. When you leave a company, if you work for a company for a long time and you've been putting money into your 401k in this bucket, and you leave that company to go work at a different company, you will roll your money over into this bucket. So you'll do a rollover from your 401k into your IRA. Now, there may be reasons you want to keep your money in the 401k, but typically, most of the time, you want to put it in an IRA because you have way more options. Like, for example, I told you could not invest in the SPY. You'd have to invest in whatever the company sets up. And usually they're pretty limited options in a 401k. And if it's a government plan or a charitable organization or you're a teacher, it's the same thing. You're only going to have options that they set up for you. But when you do an IRA, it's really unlimited options. So my clients at Bayrock Financial, we set up IRAs, and they can invest. You can invest in anything, and so, including the SPY. Private equity stuff, alternative investments, so many options. And that's why you want to roll your money over into your own IRA account. So that's what that bucket stands for. And it does have some rules, boundaries, and limitations. But I want to just highlight that this IRA bucket, like the 401k bucket, is tax deductible. And the money that you put into that bucket will grow on a tax-deferred basis, which means you don't pay tax on the money, the growth. You get a tax deduction. So the money that you put into it, you get a tax deduction, but you don't have to pay tax. So again, if you're using these strategies that I'm talking about, like portfolio rebalancing, that requires that you sell off some of the assets that have had big gains so that you can buy some of the assets that are discounted, that have gone down. And when you do that, if you did that in this bucket, you would pay tax on the profits every time you did that. So that's a drawback that costs you money, especially if you're in a higher income range, which many of you will be in a much higher income bracket as you get older and spend some time in your careers. You're going to start making some really good money. And then you're going to be in a higher tax bracket, and that's when this becomes really costly if you're doing trades. If you're making money and investing in this bucket, it's going to end up costing you a lot in taxes, and that's why tax-advantaged investing is such a powerful leverage for you. It's a powerful way for you to increase your wealth over your lifetime. So these types of accounts are important. So again, the 401k, when you switch jobs, it goes into your IRA. Again, it's tax deductible, and it's got some rules, some contribution rules. And if you make too much money, you can't get the deduction. So you're going to learn this week what is the maximum amount of money that you can earn and still be allowed to deduct the taxes. Tax law is always changing. There's a lot in the pipeline right now for tax changes with Joe Biden's Build Back Better plan. We're waiting for the new law to go into effect. We don't even know what the new law is yet, but it will have some changes in the tax code. And so some of the rules related to this bucket could change. So now we have inside of this bucket a smaller, more beautiful, more valuable bucket. And anybody want to guess what this bucket's for? What do you think this gold bucket? It's not that much smaller than the IRA bucket, but it is a little smaller. And this bucket is for, anybody want to post a comment? This is a Roth IRA, a tax-free type of account. It's the only bucket that's tax-free. And what that means is you invest inside of this type of account, and when you make gains and you take the money out, let's say, let me give you an example. I'm just going to give you an example. So in 2009, Apple was trading at $125 a share. I'm going to just look and see what is Apple trading at today. Apple, I'm going to open this on my iPhone. I'm going to find Apple. You may have Apple up already on your device, but there's a chart of Apple. It's kind of hard. So you can't really see it. I know I should have my iPad going, but I'm not doing that today. I just want to look at the chart. Apple is trading at $150 a share today, which I told you that Apple was trading at $125 a share back in 2009. So just think about that for a second. If Apple was trading at $125 a share in 2009, it's $150 today. You would think that's not a very good gain, right? But the thing is with Apple stock, it did a reverse split 7-1, and I want to say it did another one 11-1. And usually at this point I do the math for you. We spend a few minutes and we just do an illustration of how much money you would have if you had invested in Apple stock. But I don't have my iPad up, so I'm not going to do that today. I'm just going to tell you this. If you would have invested in Apple stock in 2009, if I would have taken $100,000 and put it in Apple stock in this account and sold it today, I would have a massive capital gain. Massive. It would be worth, that $100,000 would be worth, I want to say $7 million. It's a massive number. And you can do the math yourself. If you invested in fact, I might make that a what do you call those extra credit assignments, and say, just go do the math. If you invested $100,000 in Apple stock in 2009, assuming it was $125 a share, which I know it was at one point because my friend Adam and I were looking at Apple stock. Hey, Adam, I got a text message from Adam just a few minutes ago, by the way. I don't know what he was. Any recommendations? How are you? Hi, it's Adam. Hope you're doing well. Random question. I thought of you when trying to locate a good for a for a you good contract attorney. Oh, he's setting up a contract, a state attorney. So Adam, I'll get you a recommendation. Absolutely. Anyway, this is my friend Adam. That's Adam. Great guy. He works at ADP. And back in 2009, Adam and I were sitting around talking about investing like we do. And we were looking at Apple stock, and we both thought that's just a lot. That's a lot. $125 for Apple. I mean, you got to remember in 2009, the market was just having this terrible, terrible drawdown. It was scary. And so we're looking for where's a good opportunity to invest, and we thought Apple stock was just too expensive. So it's going to be an extra credit assignment, and it's amazing how much you would have made if you invested in Apple stock, $100,000 back then. So yeah, today it's trading at 151, but that's absolutely irrelevant because of the reverse splits. So I'm looking at Marco's comments. So Marco is saying, I don't know how you did this so fast, but he's saying it would be worth 12 if we would have put $100,000, or he says 1,000. $10 meaning 1,000. I'm not sure. I'm not exactly sure if you're right there, but he's saying 12,900,000. Oh no, that's 12,000. So he's saying $1,000 would have turned into almost 13 grand, 1,100%, and that's probably right. So if you did that by 100,000, he Googled it. Okay, great. That's it. So that's not going to be, that would be too easy of an extra credit assignment if you can get the answer that fast. I mean, how do you guys get so much information? When I was in college, we had chisels. Anyway, back to the lesson. The point is, if you would have bought that Apple stock, if Adam and I would have invested $100,000 in Apple stock and this account, and we had 1,100% profit, that means we would have had to pay tax on all of that profit. However, if we would have had $100,000 in this account, this Roth IRA, this year in April, I turned 59. You're going to learn that one of the rules in this type of account and this type of account, the IRA and the Roth IRA, you can't take the money out without penalty until you turn 59 and a half. So I am 59 and a half. I turned 59 in April 15th. So on October 15th, I became 59 and a half. So today, if I took my Apple stock and sold it in my Roth IRA, the investment that I put 100,000 in, it would be 12, according to your numbers here, it would be $12,957,000 if I'm doing my math correct. A massive number, and I would pay no tax on it. I'm getting a call. Sorry about that. So that's the beauty of this, no tax. Now, the difference between an IRA and a Roth IRA, if I would have done the same thing in my IRA, I could have sold it and not paid tax. So I still have the same amount in this bucket. But when I took the money out of this bucket, I would have to pay the taxes on it as I take it out. Not true in the Roth IRA. When I take the money out of the Roth IRA, I pay no tax. It's tax-free because the money that I invested in this, I already paid the taxes on that $100,000. If I would have had $100,000 in my Roth IRA in 2009, and I would have purchased Apple stock with the entire $100,000, today it would be worth almost $13 million, and I could take the money out of my account today, me being 59 and a half, and I would pay no tax. That's an amazing gift. I don't know if that's going to stick around for your lifetime or even my lifetime, because the U.S. government needs your money so they can go blow it on all kinds of stuff that, well, they're going to spend your money and my money in all kinds of ways that would make no sense to a normal human being. And this account type allows you and me to grow wealth without paying tax if we're smart. And somehow I just can't imagine that our government is going to let us keep doing that forever, because they want the income from that they could have gotten from that kind of gains. So wealthy people do those kind of things. Tax-advantaged investing is really nothing more than you understanding the tax code enough so that you can take advantage of it. The IRS makes the rules. Your job is to take advantage of the rules. That's the whole point of tax-advantaged investing. So that's how those types of accounts work. We've got a 401k type of account, a tax-deferred IRA type of account, and the tax-free Roth IRA. Nothing like this exists except the Roth IRA. So this week you're going to do some homework, and you're going to learn about the rules, boundaries, and limitations for those different types of accounts, just to get you familiar with how they work and what they are. It shouldn't take you too long, but it's important. It's important because tax-advantaged investing is important, and you'll be clueless about tax-advantaged investing if you're clueless about types of accounts. And so I hope that you never again in your life think of a 401k as an investment, or an IRA as an investment, or a Roth IRA. These are not investments. These are types of accounts. Inside of each of those accounts, you get to choose what you're going to invest in. So, I mean, that's maybe inside baseball, but I've heard so many people talk about these types of accounts as if they're investments, and they're not. You still have to choose what are you going to invest in, and you still have to manage the investments inside the types of accounts. But before you can do that, you have to manage the types of accounts. That's what tax-advantaged investing is, and it's one of the most important ways to build wealth is to manage the types of accounts. So that's it for today. Those types of accounts are important for you to understand, and they're part of this course because they make such a big impact on the outcome of your investing plan over your lifetime. So we don't have a weekly assignment. Harsh, I don't know where you got that. You do have a weekly assignment. And yes, you're going to do some research on different types of accounts. That is your assignment, and I will post it in Blackboard. So I just mentioned that it's easy. It's not a difficult assignment at all. You're also going to go into your plan this week, and you're going to do some tax allocation. So last week we did asset allocation in your plan, but your plan also has the ability to allocate your investments into different types of accounts so that you get to see how it moves the needle when you do good tax allocation. So you have asset allocation for your investments, but you have tax allocation for your types of accounts. Imagine that. So your assignment this week is going to involve both learning a little bit about these different types of accounts, what are the rules, boundaries, and limitations, and applying that knowledge and watching the needle move on your plan as you just change the allocation, the tax allocation. So that means you're going to go in and you're going to move some money around from one type of account to another type of account, which means you're probably going to have to create a Roth IRA account in your financial plan. Yeah, it's going to be imaginary, but that's okay. It's going to show you how important it is and how much it moves the needle when you have investments that are allocated into different types of accounts, different tax strategies. So that's going to be your lesson. Again, it's not difficult, but it is going to involve some research and a little bit of tweaking in your financial plan. So if you have questions throughout the week, you know what to do. Post them in GroupMe, and then those of you who are like way ahead of the game, you can answer and collaborate and help other students, and that's how you earn your 200 points class participation. We're getting close to the end of the semester. Your capstone assignment is worth 200 points. I think it's 200 points, pretty sure. And you get 200 points for class collaboration. Most of you are doing fantastic. So again, if you have questions about this week's assignment, just post those. If you can't get your questions answered in GroupMe, Bridget will reach out. I'll do a tutorial, and I'll post that so that you get answers so that you can get the assignment done, completed, and get all the points that you want. So have a great week, and I'll see you soon, and I appreciate you being here. I'm going to sign off now. So Take care. I'm going to wait just a second and see if there are any questions in Zoom. Post those questions now. I'm going to run over here and stop the broadcast now.